January 27th, 2026, 3:17 a.m. Eastern Standard Time. In the basement trading floors of Manhattan's financial district, algorithmic systems began executing trades that would shatter every assumption about silver market stability. Within 17 minutes, silver prices exploded from $31.40 per ounce to $47.80, a 52% increase that triggered trading halts across every major exchange from New York to Shanghai. The catalyst was not a single news event or government announcement. It was the simultaneous activation of emergency procurement protocols by 47 major corporations across 6 different industries, all competing for the same finite silver supply that financial markets had assumed was adequately available. Tesla's supply chain system, monitoring global silver availability for battery production, detected critically low inventory at major dealers. The system automatically triggered Strategic Material Emergency Protocol, initiating immediate purchase orders for 12 million ounces at any price. Within minutes, similar protocols activated at Apple, Samsung, General Motors, Ford, BMW, and dozens of manufacturers whose production lines depended on steady silver supply. But the real shock came when buying algorithms reported systematic delivery failures. Major silver dealers displayed out of stock across their entire inventory. London's Johnson Matthey suspended silver sales. Shanghai Gold Exchange halted trading after delivery requests exceeded available inventory by 340%. The mathematical impossibility became undeniable. Global industrial demand had exceeded available supply by such a massive margin that the existing market structure could not function. Yet the most telling aspect was the coordinated silence from major financial institutions, suggesting they had been anticipating this crisis and positioned accordingly. The silver shortage had been developing for 18 months, hidden beneath financial complexity that obscured the fundamental reality of accelerating consumption and declining production. Global silver mining peaked in 2016 at 886 million ounces annually and had declined to approximately 820 million ounces in 2025. The decline was structural, driven by ore grade deterioration, making extraction increasingly expensive and environmentally challenging. Simultaneously, industrial consumption accelerated at unprecedented rates. Electric vehicle production alone consumed 67 million ounces in 2025, compared to 23 million in 2022. Solar manufacturing absorbed 185 million ounces, a 73% increase. 5G infrastructure required 41 million ounces for components with no substitute materials. The mathematical deficit was undeniable. Annual consumption ran at 1.1 billion ounces, while mining provided only 820 million. The 280 million ounce deficit was supplied from existing stockpiles rapidly approaching depletion. Higher prices failed to generate new production due to geological constraints. The highest grade deposits were exhausted, forcing miners to extract from lower grade ores, requiring exponentially more energy per ounce. Industrial demand proved inelastic because silver's unique properties made it irreplaceable. Electronics manufacturers could not redesign circuit boards without compromising performance. Solar companies could not substitute alternatives without reducing efficiency. Defense contractors could not modify weapon systems without years of testing. The financial services industry had created paper silver markets many times larger than physical availability. Silver derivatives represented claims on 2.8 billion ounces, while global stockpiles totaled less than 1.2 billion ounces. Exchange-traded funds relied on statistical assumptions about redemption rates that proved invalid when institutions demanded physical delivery. The London Bullion Market Association operated with fractional backing daily trading volumes exceeded 200 million ounces, while vault inventories contained less than 35 million. Central banks focused on inflation metrics, excluding commodity volatility, failing to monitor strategic material availability. Corporate risk management substituted financial hedging for supply chain security, leaving industrial users vulnerable to shortages that financial instruments could not address. Industrial manufacturing collapse. Electronics manufacturing, consuming 240 million ounces annually, faced immediate crisis. Samsung's semiconductor plants suspended production after silver supply contracts terminated. Apple confronted iPhone production shutdown as silver was essential for circuitry, cameras, and charging systems. Stock fell 18% as investors recognized manufacturing impossibility without available silver. Automotive industry encountered severe disruption as electric vehicles required significantly more silver than combustion engines. Tesla's Gigafactory faced shutdown as battery systems, motors, and charging infrastructure required silver components without viable substitutes. Ford suspended Lightning production after 3 days of attempting silver procurement at prices making production unviable. Energy sector. Paralysis. Solar energy development faced crisis as panels required silver for electrical connections. First Solar, Canadian Solar, and Jinko Solar suspended projects as supply contracts terminated. Renewable energy mandates suddenly appeared impossible. The EU's Green Deal requiring carbon neutrality by 2050 depended on solar expansion that could not proceed without unavailable silver. Utility companies with solar programs faced stranded assets. NextEra Energy and Brookfield Renewable suspended billions in investments. Government mandates assumed unlimited material availability that no longer existed. Defense crisis. Military equipment manufacturing faced immediate problems, as weapon systems, radar, and electronics required silver for performance that could not be compromised. Raytheon suspended Patriot missile production. Lockheed Martin faced F-35 delays. The Department of Defense activated Defense Production Act protocols, but discovered suppliers could not guarantee delivery at any price. Financial system stress. J.P. Morgan Chase faced potential $40 billion losses on silver derivatives as prices rose beyond risk model parameters. Exchange-traded funds discovered insufficient holdings to satisfy redemption demands. SLV suspended new share creation, acknowledging they could not purchase backing silver due to physical constraints. Commodity trading firms faced margin calls exceeding credit facilities. Credit markets repriced corporate debt for silver-exposed companies. Insurance companies faced business interruption claims with unclear coverage for market failure-caused shortages. The irreversible transformation occurred at 2:47 p.m. EST on February 8th, when the Department of Defense classified silver as critical defense material under the Defense Production Act, authorizing government requisition of private stockpiles and federal control over all silver allocation. Within 6 hours, the EU, UK, Japan, and Australia issued similar declarations, effectively nationalizing silver markets. The market response was immediate. Every remaining U.S. silver dealer displayed inventory seized, closed by federal government. Private ownership exceeding 100 ounces became illegal. Commercial trading suspended indefinitely. International markets collapsed as governments recognized free market mechanisms were inadequate for strategic material distribution. The crisis revealed the mathematical impossibility of maintaining industrial civilization through market mechanisms, when essential materials became scarce relative to irreducible requirements. Modern economies had evolved beyond natural resource, carrying capacity without coordination that markets could not provide. National sovereignty was redefined. Countries without silver resources faced technological dependence regardless of traditional alliances. Military alliances proved inadequate when members competed for insufficient resources. Financial systems creating paper claims many times larger than physical availability collapsed when users demanded actual delivery. Central banking faced powerlessness. Monetary policy could not address real resource scarcity through interest rate manipulation. The Federal Reserve could create unlimited dollars, but not silver that did not exist. Government authority to seize private property expanded beyond wartime to peacetime resource scarcity. 8 months after the crisis began, the global economy had stabilized into a configuration bearing little resemblance to the previous market-driven system. Silver remained available only through government allocation, prioritizing strategic applications over commercial demand, eliminating private speculation entirely. The crisis exposed the fundamental impossibility of maintaining technological civilization through purely market-based allocation, when essential materials became scarce relative to requirements that could not be reduced. Government control became permanent, establishing precedent rapidly applied to rare earths, lithium, and cobalt. International trade restructured around resource block alignment rather than economic efficiency. Corporate strategy shifted from profit maximization to resource security. Just-in-time manufacturing was replaced by strategic stockpiling, assuming periodic unavailability. Private silver investment was eliminated, with supplies allocated by government assessment rather than market prices. The transformation was irreversible not due to policy choices, but geological and industrial realities unchangeable through human decision-making. The silver crisis marked the abundance era's end and scarcity era's beginning, requiring fundamental changes in systems designed for growth rather than sustainability. Private ownership of strategic materials was permanently subordinated to collective needs. Silver markets would never return to purely private operation. The crisis forced recognition that modern economy was ultimately dependent on physical reality rather than financial mechanisms. And technological civilization required resource availability that could not be guaranteed when geological constraints imposed limits that economic growth could no longer circumvent. The silver shortage would be remembered not as a resolved commodity crisis, but as the moment human civilization encountered planetary resource limits requiring fundamental changes in economic systems. Political institutions and social expectations shaped by centuries of increasing abundance that had permanently ended.